This presentation is part of the AgroEco-IN project funded by the Erasmus Plus program of the European Union. The current chapter discusses and exemplifies financial reporting of biological assets for agricultural companies. This chapter covers several topics: the importance of financial reporting for agricultural business, the International Financial Reporting Standards, or IFRS, applicable to agricultural activity, how to value agricultural activity, biological assets, and agricultural produce, how the valuation of these items affect the company's assets and profits, and the chapter also provides many real-life examples and discussions of implications for business performance. Companies in all countries and in all economic sectors need to provide information about their financial performance and financial situation to several stakeholders, such as investors, creditors, governments, customers, and many others. They do so by preparing regulated financial information, which is publicly disclosed. As stakeholders rely on that information for their economic decisions, financial information must be reliable, transparent, and comparable across companies and across countries. And thus, financial information is commonly prepared using international accepted rules, IFRS, or International Financial Reporting Standards. IFRS are a set of high-quality standards issued by an international and independent organization, the International Accounting Standards Board, or IASB. Currently, about 170 countries around the world require companies to prepare their financial information using IFRS. And since 2005, using IFRS is also mandatory for European firms that are listed in capital markets across Europe. Financial reporting rules for agricultural companies deal with two important problems. First, how agricultural resources should be recognized in the assets of the company. And second, how agricultural resources affect the company's profitability. The answer to these questions will impact on how stakeholders perceive the performance and the financial situation of the business. Agricultural companies develop activities such as farming, crops, forestry, production of fruit, wine, etc. Agricultural companies are different from manufacturing or service companies because the assets used in their activities are subject to biological growth, reproduction, harvesting, etc., and thus they need specific financial reporting rules. IFRS provides specific financial reporting rules for the agricultural sector. The rule dealing with agricultural activity is International Accounting Standard 41 or IAS 41. This standard defines the specific accounting treatment for agricultural assets, the information a company needs to disclose about these assets, and the valuation methods for biological assets and agricultural produce. The agricultural sector is an economically important sector in many countries, including European countries. There are large European businesses that operate in the food industry, wine, perfume, timber, and paper industry. For example, the companies included in the Financial Times list of 500 largest European companies managed about 10 trillion euros in biological assets on average between 2008 and 2018, and these assets contributed to about 80% of their total profits. One of the largest European companies operating in the forestry and timber sector is the Swedish company Svenska Cellulosa. The company manages 3 billion euros of assets related with agriculture and these assets generate most of the company's profits. Another example is company Louis Vuitton Moet Hennessy, a French multinational operating in the luxury, perfume and wine industry. They manage the famous Moet and Chandon champagne and Hennessy cognac. The company's biological assets are 2.5 billion euros, generating more than half of the company's income. But what is agricultural activity? For example, are all business activities of Louis Vuitton considered agricultural activities? Financial reporting rules define what should be considered agricultural activity. According to IAS 41, agricultural activity is the managed by an entity of the biological transformation and harvest of biological assets used for sale or for conversion into agricultural produce, such as farming of animals, forestry, crops, growing trees, etc. IAS 41 also defines the concept of biological asset and agricultural produce. A biological asset is a living plant or living animal that has biological transformation, meaning the natural growth of cattle, trees, crops, and plants, the procreation of animals under a reproductive scheme. Agricultural produce is the harvest produce of the biological assets, for example, milk from cows, wool from sheep, grapes from vines, etc. To sum up, agricultural companies engage in agricultural activity that uses biological assets to create agricultural produce. International financial reporting rules require that biological assets are reported at its fair value, applying IAS 41, and that the agricultural produce of these assets be reported at its cost, as any other inventory. The assets of a business are considered biological assets if two conditions are met. First, the assets must be a living animal or living plant with biological transformation. Second, the animal or plant must be used in agricultural activity. For example, horses used in a farm for breeding are biological assets because they are a living animal and breeding is an agricultural activity. But horses used by a zoo to perform shows is not a biological asset because animal shows is not part of an agricultural activity. A few more examples of biological assets are plants used in the perfume business to produce ingredients for the perfumes, bacteria used by a dairy company to produce yogurt, and salmon grown by an aquacultural business. Examples of animals that are used in the business but are not biological assets include fish caught naturally in the ocean, seals and dolphins used by an aquapark for kids' entertainment. In both cases, the animals are not being used as part of agricultural activity. That is, there is no biological or natural growth of the animals with the intention to sell or breed. An important question for investors and other stakeholders is how the biological assets contribute to the company's profits. Biological assets generate profit through sale, production, and through its natural transformation and growth. So how should companies value the natural transformation or growth of a living animal or plant? International financial reporting standards define that biological assets should be valued at its fair value less any costs to sell. That is the equivalent to the net market value we would obtain in the sale of the asset at a particular moment in time. But there are exceptions to the use of the fair value method. When the animal or plant is not involved in agricultural activity, when the plant is a beer plant. There are specific rules for these plants. When the fair value of the asset is not available, for example, when there are no prices in an active market for that asset. Here's a practical example. A company has cattle for breeding with an initial acquisition cost of 1,000. 1 year later, the market value is 1,200, so the company must recognize the gain or fair value gain of 200. So the biological asset of the company goes up by 200 and profit also goes up by 200. This example shows clearly how the fair value method impacts on business profitability. Example shows clear. But the fair value method has disadvantages. Some biological assets may not have reliable market prices, and hence the company may have to estimate their fair values. These estimates of fair values are based on management assumptions, which may lead to subjectivity, discretionary choices, and even manipulation of the earnings of the company. And all these may impact on shareholders' decisions about the business. Also, as the estimates can vary from period to period, they may result in increased volatility in earnings. And volatility in earnings is typically viewed by investors as an indication of risk and uncertainty about future profits. Some studies about agricultural companies conclude that banks and other creditors actually charge higher cost of capital to these companies when they use the fair value method. Besides reporting the value of biological assets, companies must disclose additional information in the notes to the financial statements. For example, the company needs to disclose the gains and losses from measuring the fair value of biological assets. The company should also describe in detail the types of biological assets. The company must explain the assumptions used to estimate fair value of assets that do not have market prices, and the company should also provide some sensitivity analysis of the estimates. For example, what would be the fair value of the forest trees if the timber production was less than expected? Here are some examples of disclosures provided by European companies. AgroGeneration, a company based in Ukraine, explains in the financial statements that its biological assets are valued at fair value. It also explains that some fair values are estimated based on assumptions about climate conditions and selling prices. Finally, the company warns stakeholders that changes in these assumptions may have a great impact on business profit. Valorec, an European company with eucalyptus plantations in Brazil, reports the revenues generated by the plantations, which are valued at its fair value. And Svenska Cellulosa, a forestry company, provides a sensitivity analysis of the impact on forest values of changes in fair value assumptions about discount rates, wood prices, felling costs, and the rate of production of wood. Next, a brief discussion of the reporting rules for bearer plants is presented. Bearer plants are a special case of living plants that are used to obtain agricultural produce. Typically, bearer plants like rubber trees, for example, are mature plants that produce products over many years and are rarely sold. And there are special rules for bearer plants. Essentially, mature bearer plants are viewed as an equipment of the business. Their conceptual usage is similar to the one of a manufacturing equipment, thus they are not treated as a biological asset. They are reported by the company as property, plant and equipment, and they are valued at their historical. The valuation of bearer plants in the company's financials depends on the stage of maturity of the plant. For example, grapevines, rubber trees or fruit trees are valued at their acquisition cost till they reach maturity. After the tree or plant is mature and ready for production, the company can choose to value it at historical cost with annual depreciation or at revaluation, adjusting the historical cost from time to time. Agricultural activities often receive government grants and subsidies, and financial reporting rules define how to treat these grants in the financial statements of the business. In Europe, the European agricultural policy has provided many subsidies and grants to agricultural companies, which is sometimes a topic of political controversy. Subsidies and grants take various forms, such as direct payment to farmers, subsidies based on income generated by the farm, etc. Government grants and subsidies create some challenges for financial reporting because they are often received in a lump sum amount in one period, but they finance agricultural activity over many periods after the grant is received, and that would distort the financial performance of the business and increase earnings volatility. While the grant would increase profit in one single period, the agricultural produce that the grant finances is spread over several periods. For example, a grant of 1 million to finance a plantation of sustainable grapes to produce wine over 5 years. This mismatch between cash received from the grant and the revenue generated by the agricultural activity that the grant supports would create volatility in the business profit and would affect the performance of the business. Financial reporting rules try to solve this mismatching problem with the following requirements. If the grant is conditional on a certain action, for example, a company should not produce crops during a number of years, or a company receives a grant to acquire the herd of cows under the condition that the cows must be kept for 4 years, then the grant is added to profit when the action is completed. But if the grant is unconditional, it is included in the company's profit immediately when cash is received from the government. Overall, the current chapter discusses the importance of putting forward regulations on how agricultural companies should present in their financial reports their agricultural activities. These regulations are important because they define how assets and profits are measured, and that information is crucial for stakeholders to make judgments about the performance of the business.